Thanks, Matt. For the actual slides you'll see will be focused on the trucking industry, where I think probably the biggest pain point tends to be, but I can address some broader issues if we have time. And I should also point out that I'm not going to get into intermodal, but really domestic intermodal follows pretty much dry van truckload. So when rates are soft in dry van truckload, they're going to be soft in intermodal and vice versa. So it's good to be here. I feel like I'm the fish out of water because I'm not in the publishing industry or the printing industry. However, I will say that my career started out in print publishing. I for the first dozen plus years of my career, I worked for McGraw-Hill, but not in the book publishing. I worked in loose leaf newsletter publishing, which I don't think exists anymore. But it was a big deal back in the day in B2B. So I did that and then went into magazine publishing. So 2/3 of my career very much in the printing field as far as how my product got read. I also enjoyed John's discussion earlier. When I heard his background, I had to look him up. And he graduated from GW a couple of years after I graduated from a school a couple of miles to the west. And I was in DC for most of the 80s and 90s. And I have to say that I have several friends who would be much more impressed that he was the manager of the 930 Club than that he's the CEO of Macmillan. But in any event, let's move on. As I mentioned, I'm only going to focus my slides on trucking. But if you go to this URL, this accomplishes two things. One is if you see visualizations that you find impressive or that you want to investigate, rather than just taking a photograph with your phone, you can just capture this URL and you can download a PDF of the entire presentation. The other point is that you can also get a complimentary copy of one of our products, which is called Shippers Update. We publish products in trucking, shippers, rail and intermodal product specific. We also do products regarding commercial vehicle forecasting and railcar forecasting. But this product, you would be able to download the October issue. This actually does get into not only trucking, but also rail and intermodal. And I should talk a little bit about what we do exactly at a broad level. I'm not going to go into great detail, but I will say that I'm very jealous of Kyle's access to data, because unlike Kyle, who has real-time access to data, of course, that is within their own system, we don't have that luxury. We're independent. And we work with a whole lot of private sector partners, but also government data and so on. So our forecasting model for freight, volume, and utilization and rates is really based, it's an econometric model, which means we're basically taking economic data and running it through a series of filters that we've vetted over time. And you have to do that in trucking because trucking is so large and so diverse, maybe not so much in LTL, certainly in truckload, which is where I'm going to focus most of my time today. You can't really get a full sense of what's going on by doing a survey of members or pulling from a select group. So that's kind of what we do. So I'm really only going to focus on two things. And I thought, since this is not a group that is specific to the trucking industry, and I think most people in the room who's do not have supply chain titles or transportation titles. Obviously, transportation is a huge part, either directly or indirectly, what you do. I thought it'd be useful to kind of go through the last 4+ years and explain why the market did what it did, because I'm sure most of you suffered through 2021, early 2022, and are potentially, I hope you are, enjoying the benefits of 2024 and in 2023 in terms of the ability to get capacity, and most especially the ability to get a rate that's comfortable. Understanding why both of those happened, I think, is important for you to understand in terms of how to look at the market going forward. So that's what I'm going to spend about half my time, and then the rest of it I'm going to be talking about what our actual outlook is really for the coming, roughly 18 months or 16 months or so on. Okay, so understanding the truck market. We're going to start with the upswing that we saw and what that means for, how it led to what we ended up with. So first of all, we all remember, March, April of 2020. It does start to seem like ancient history, but we all do remember it. And as far as the trucking industry is concerned, the biggest consequence there was twofold. The first one was that we had trillions of dollars in stimulus and no ability to spend that on vacations and concerts and so on. And so we had a surge in spending on goods. I hope also books, but I haven't actually looked at the data to see. I should also point out that this is real spending. You'll see as I go through here, I use the word real a lot, and that's because since basically late 2020, early 2021, unless you're looking at inflation-adjusted dollar value data, it's pretty much meaningless. So we're looking at inflation-adjusted spending. So when you see that these figures going up, it's not because of inflation. The government is taking inflation out of that. So first consequence, big surge in spending on goods. At the same time, the pandemic led to a big drop in employment in trucking. Well, supply and demand, I think we're all familiar with the dynamic. That led to incredible stress in the market. We had a surge in spot rates to levels we've never seen before. I'm going to focus on dry van and flatbed. I'm sure almost all of you use dry van. Some of you may be using flatbed for inbound logistics and other things. So I'm going to talk about both of those markets. I'm assuming you're not interested in refrigerated. Obviously, you may be using refrigerated during the height of the markets because you can't get anything else. But we're going to focus on dry van and flatbed. So dry van spot rates surged, went to levels that have never been seen before. On the side that matters to dry van as well, because industries like automotive, for example, account for roughly 30% or 25% of dry van volume, but especially for flatbed, we also had a recovery in manufacturing, but not to the same degree. If you go back here, we had this enormous surge that went well above prior levels, but in manufacturing, basically all we did was come back to more or less where we were before the pandemic for a long period of time, and that had consequences in terms of how the rates played out. The other thing, though, that we did see that was more like spending was a big jump in housing starts. Housing starts, as well as manufacturing, are the two biggest industries for flatbed. And again, just like the truckload sector, we had a big drop in jobs, and in fact, have never really recovered in employment in the specialized sector, which is driven primarily by flatbed and to a lesser extent by tank. That too led to a little bit more of a camel hump effect, but it did lead to a big surge in the spot rates within the flatbed sector. So that's kind of where we were going through pretty much the end of 2021, heading into 2022. So let's talk about the downswing, why that happened and why that matters today. So those spot rates, guess what, led to more money for people who were living in the spot market. So this is, you don't have to worry about the details of this, but the bottom line is incomes surged in all of the three major spot markets that we follow, which is dry van, flatbed, and refrigerated, to levels where a one-truck operation was pulling down, in a lot of cases, $150,000 a year at the peak. This is including the cost of fuel. In other words, so even after fuel, they were making that kind of money during the peak of this. Well, what did that mean? That meant we had an enormous increase in the number of carriers, the vast majority of which only have one truck. Now, I didn't cover this during the upswing. This was part of the upswing, but it really was not part of the economic effects of the upswing, but it is very much part of the downswing, because we had this big increase in the number of small carriers, principally, in the market. Then we had a tapering off of spending on goods almost at the same time. So we had this surge of new carriers entering the market. Then goods sort of leveled off at high levels, granted, but it then basically over the next year or so sort of reverted to the longer term trend, which is the dashed line there. So you see that we had basically a surge in more drivers entering the market, at least for small carriers. At the same time, things started to kind of ease off. Meanwhile, manufacturing input, even though it didn't have this great surge, did taper off as well, did loosen. So you had the same phenomenon affect flatbed, and guess what? So did housing starts. So housing starts peaked right around the end of 2022 or the end of 2021, came down during 2022, and it kind of held it at a high level. Granted, if you look at where housing starts are now, you hear a lot of talk about the troubled housing market. That's really a sales issue. It's not so much a construction issue, but it is way lower than it was prior to the pandemic. So what did that mean? We had a decline in spot rates in dry van. We had a decline in spot rates in flatbed. Well, guess what? The same time, Russia decided to invade Ukraine, and we saw an unprecedented surge in diesel prices. We had a $1.15 increase in diesel prices in 2 weeks. Nothing like that had ever happened. During the entire 1990s, we had a gap of, I think, less than 15 cents from the bottom to the top of diesel prices. We had a $1.15 in 2 weeks in March of 2022. And then it went up again, hitting a high of $5.81 a gallon in June. So we had spot rates coming down. We had diesel prices going up. Well, guess what happened? Incomes came way back down very quickly, especially in dry van and in refrigerated freight. The black line, by the way, is what a company driver or an employee driver would make. It's kind of a proxy for that, at least. So in a lot of cases, we went from having these drivers making dramatically more than they would make working for a trucking company to very quickly making less than they would make working as an employee driver. That led to two things simultaneously. One is we started to see declines in the population. Instead of a net increase in carriers, we started to see a net decline in carriers. Now, you'll notice, and I'll talk about this in a minute, that the decline that we've seen does not match the increase. We have not come anywhere near losing the number of carriers that we added. Again, carriers is not capacity, because when we look at the total market, the number of carriers is really not the issue. It's really the number of drivers. So why am I focusing on that? Well, it's because when incomes dropped all of a sudden and diesel prices went up, guess what? A lot of these small operations, these one truck operations, start to think, well, I think I'd be better off working for a trucking company where I don't have to pay the fuel myself and I don't have to worry about what the rate is. I'm going to get paid something per mile. So the larger carriers, the larger truckload carriers had been spending, millions of dollars to recruit during all this time, right? Because they were trying to meet that peak demand that we talked about earlier. Well, all of a sudden, it took off. Q2 of 2022 saw an increase in employment in general freight truckload that nothing like that had ever happened before. So we had this large jump in truckload payroll employment. And truckload payroll employment is primarily going to be somewhat larger carriers. They're going to be, 8 or 10 truck or higher, because smaller than that, the driver's probably not going to be in the unemployment insurance program, and they're not going to be in the Bureau of Labor Statistics data. So what you end up with is this situation where we have both a 4% roughly increase in truckload payroll employment and still a 36% increase in the number of carriers, all of this relative to February 2020. So we have higher capacity in truckload, and we have really much higher capacity in this small side of the market, which is primarily operating in the spot market on behalf of brokers. So you sort of look at the two charts. Think of the chart on the right representing broker capacity, and the chart on the left is basically asset-based trucking capacity. But the larger point is, both are above. So we can't have capacity lower than what we had before the pandemic. There's no way. Now, pinpointing exactly what that means in terms of capacity is tougher than you might think, because the payroll employment data is not just drivers. It's a lot of people. And the one truck operations are primarily just drivers, but we don't know how much utilization they're having and so on. But we do know that at this point, we have more capacity on average than freight on average relative to the history. And we know that because we calculate that every month. We call it active truck utilization. And think of this chart as essentially a barometer of how tight the trucking industry is. The calculation is, here are the number of Class 8 trucks FTR estimates needed to haul the freight that's available, divided by the available trucks to do so. And by available, I mean seated and also, productive. So during 2021, for example, a lot of drivers were not all that productive because they were hauling less than full loads, because the idea was we had to keep stuff moving. So we're talking about a much more loose market. And you may hear about the driver shortage. Despite what anybody will say, there is not a driver shortage today. Now, we are headed back toward one eventually, but there is plenty of driver capacity today. And, spoiler for the rest of the presentation, will be for a while, we believe. A while is not necessarily a decade or 5 years or even maybe 2 years, but it certainly will be for the coming year or so. This is similar data to what I showed earlier when I showed the linear chart showing rates going up, rates coming down. What you're looking at here, though, is more of a year-over-year comparison. So you can see kind of where we are relative to where we are at other points in time. I know it's a lot to kind of look at, but what it really just highlights, where we were in 2021 and 2022 versus where we were, before the pandemic and, basically today and last year. Today and last year, a very normal environment for rates. We had a little bit of softness before Hurricanes Helene and Milton. Those two added a little bit of strength to the market, but not a lot, not compared to what we've seen during hurricanes in the past. Hurricane Harvey, for example, in 2017 had a huge impact on the market. Now, part of it is just where it happened. Houston is a big transportation market. Not so much the areas where the hurricanes hit, especially Milton, which of course is close to here. But all it did was bring rates back to essentially where they were running before August, because August, September was a soft period of time. And this data actually runs through last week. I updated this chart this morning. So it looks like Milton and Helene have basically played out. And at this point, we're back to kind of the same environment we were in June, July. And that really tells us that, there is not an inflection in the market right away. We're not seeing one come. Flatbed's very similar. It's been a lot more stable. There's a lot of reasons behind that we don't need to get into, but it too had some softness in September. It's kind of reverted back to last year levels. You can see that I mentioned how the recovery in manufacturing, such as it was, took longer than obviously goods, which went up because of stimulus. That's reflected in the rates. You'll see here that 2022 actually was the peak in rates for flatbed in the spot market, not 2021. So it took a lot longer for it to get there. It also came down a lot more gradually. But again, flatbed is still running more or less like it was last year and is at a pretty normal level. Any questions on this before I talk about where we're going? Okay. So let's talk about where we're going. I want to talk about some economic data first. And these will be basically the same charts you've already seen, but with a different sort of focus. So real spending on goods I pointed out earlier, in fact, I showed this chart just a few minutes ago with the focus on it's slowing. But you will see that it is growing. So you think, okay, well, that's good for freight. And yes, it is. But the freight market is not enjoying that growth as much as you might think for a couple of reasons. One is we're going to look at durable goods and we're going to look at non-durable goods. So in durable goods, things like vehicles and computers and a whole bunch of other things. If you look at this chart, you can see that there's really strength only in one area, and that is what's called recreational goods and vehicles. Now, that, of course, is going to include motorcycles and ATVs and boats and things like that. But the big kahuna in this category is essentially consumer electronics. Now, consumer electronics does not have as much freight impact as some other manufacturing because you have so much more value per density. Very, I guess, kind of the opposite of books, I suppose. Books take up a lot of space. Computers tend to not take up very much space. They're very valuable. The rate you get for hauling them probably is pretty good because you have to have a lot of security in place, especially over the last couple of years where we've seen a lot of fraud and a lot of increase in theft. But it doesn't produce all that much freight. So it's not putting as much upward pressure on truck freight as you might see with, say, automotive or some of the other categories. But look at the note at the bottom of the chart. This is particularly important. More than half of consumer electronics is software. Now, if you think about that, that is the internet. And I know, I'm sorry, I shouldn't have mentioned the internet. I know the internet's a bad word, but that has no impact on freight at all. If we go back 30 years, at least there were, CD-ROM cases, that had to be hauled, even though they didn't take up much space. So one of the biggest drivers of durable goods spending has no impact at all on freight. Zero. Move to non-durable goods. Again, really only one category, and it's other. Okay, well, other could be anything. But let's look at what other is really being driven by. Other is being driven by pharmaceuticals. Probably not a big surprise. We know things like Ozempic and all these others have become very popular over the last few years. And spending on pharmaceuticals is gone up dramatically. I think it's about a 40% increase just in the last 5 years, which is a huge increase. It is roughly 43% of that entire other non-durables category. Again, there's two issues here. One, pharmaceuticals, a lot of that is imported. A lot of that is brought in, by air freight, for example. But what is made here, again, takes up even less space than electronics. So when you look at consumer spending, you think, we're headed toward, higher trucking costs because consumer spending is actually starting to come back up. You have to kind of dig down and say, yes, maybe we are expecting some, but it's not going to be the kind of driver based on the trends we're seeing that you saw in late 2020 and 2021. That's not what we're going to see. It's because we're seeing, essentially a transition to an electronic world, which we thought we already had, but obviously nothing compared to what we're going to see. And that is, more or less is what is driving those data points. So let's talk a little bit about manufacturing. Well, guess what? Manufacturing, I showed was pretty weak. Well, it's even weaker than it looks if you look at two particular, if you take out two areas. High tech, again, we're back to computers, and you take out automotive. Now, automotive is a big driver. So, why are we taking automotive out? Well, one reason is it is our belief, it's certainly my personal belief, that the strength in automotive production that we've seen is probably not sustainable. And the reason is that we are back to inventory levels in automotive that are very close to what we were before the pandemic. There's still a little bit more to go in the inventories to sales ratio for automotive, but not a lot. But perhaps more to the point, vehicle sales are not coming back to pre-pandemic levels. we're still running 1 million plus units per year below where we were on average. It's volatile, but on average, we were running around 17 million autos in light trucks heading into the pandemic. We have not in any single month gone much more than just a hair above 16 million annualized. And for the most part, we've been below that. Now, why? I think we probably intuitively know, how many of you took Uber or Lyft from, the airport to here? Probably a few of you. Well, guess what? People are taking them all over the place. They're taking them in the cities, especially younger people. And there are a lot of people, especially in more urban areas, are taking Uber and Lyft instead of having cars. The other issue is more that I have to look forward to in the not too distant future is as we see the baby boom generation age out and retire, more and more of them are going to go from having a car to not having a car because they're moving into assisted living and other things. And so between those two demographic changes, we may very well not see vehicle sales get back to that level. And again, that is going, now this may not be a 2025 issue, but this is going to be an issue probably. And it is, again, one of the other things that is taking stress off the freight market, which is what's important to you, because I'm guessing your businesses don't particularly care about automotive, but how automotive affects the freight industry is important. Okay, so let's talk a little bit about our broader outlook on the economy, and this informs really or sets the stage for what our outlook is going to be for trucking. So first of all, industrial production has been basically stagnant for a couple of years now, and we expect it to be basically stagnant for the next year or more. And so as we look ahead, we're not likely to get a whole lot of upward pressure on either dry van, which, as I pointed out, is heavily involved in the manufacturing industry, even though other sectors, including obviously printed products, but food and other consumer goods are the other bulk of it. But manufacturing or dry van does get some benefit from that, but also flatbed. Flatbed is not likely to have this huge upward movement based on industrial production. As we look at gross domestic product, in other words, the economy, we see that we do not forecast a recession. We've actually never during this 4+ year period forecasted a recession. We're one of the few firms that did not actually, and we don't see one ahead either. Now, what we do see is pretty, average growth. Around 2% growth. 2% growth is okay. It's fine. We used to think that was pretty good. So it's not bad, but it's not really anything to get excited about. And more to the point, it's not accelerating. We don't see accelerating growth. One of the things we do at FTR is we take the same data that drives GDP, and we essentially slice and dice it and look at it, how it affects freight. And we do that in two big ways. One is we take services out of the equation. We only look at goods. The other one is we look at imports as a positive. That's because GDP looks at imports as a negative. It's not domestic. Therefore, it's actually a subtraction from GDP. And for that reason, actually, we get, let's see, I believe it is tomorrow, or no, I think it is Wednesday, we get the GDP estimate for the third quarter. And it's my belief that it's going to be pretty weak. And that's because imports during the third quarter were very strong. And that is going to be a negative to GDP. So when we get the GDP number on Wednesday, I would not be shocked to see it be quite weak, given that this is the week before the election. That'll be interesting to see how that gets handled. But I do think it'll be quite weak, but it'll be weak for a reason that I would argue is somewhat artificial. Because if you look at least in the near term, and obviously this is an election issue, but in the near term, just because something was not imported does not mean it would have happened here. So to count, in any given quarter, to count imports as a negative is a little disingenuous. Now, as we look at the longer term, that's one of the big debates, right? What are the effects of tariffs and all that on the longer term? But as we look at just a quarter or two, it has a negative effect. Now, conversely, I think our forecast might be a little stronger than what we have here for the same reason. Imports are a big part of freight demand. Now, it is really more intermodal than it is trucking, but it is something that we're watching. But the bigger point, this is solid, not especially strong. Even by the end of next year, you get to, 3%? 3% sort of at the bottom end, which you would start to see some kind of acceleration in freight demand. So where are we in freight demand? This is, so I mentioned that FTR has an econometric model. So we actually forecast how many truckloads there are in each of the principal equipment types based on that model. And what we see is that dry van freight is okay. It was up a little bit this year. It'll be up a little bit next year, but it is not doing anything that's going to create a lot of pressure. Flatbed is not doing well this year. I showed the housing start data, showed the industrial production data. Those are the two principal sources of freight for flatbed. The third is oil field activity, which is pretty regional, and it's also not doing very well. So flatbed's not having a great year. It hasn't really had a great few years, really, since it had that first big push up because of housing starts. So this is I showed earlier this chart historically. This is the forecast. So as we look at that sort of average level of utilization, we do have it coming up. But we don't have it coming up. If you look at 2021, if you look at 2018, which was another really big year, at least at the time, it seemed to be a big year, it doesn't get to that level. We have that utilization, which again is a pressure gauge, really kind of maxing out, somewhere between 95, 96%. 96%'s strong-ish, but it is not the essential 100% utilization that we had back in 2021. So not going to get the same kind of pressure on rates, at least not in the near term, that we had in 2021 or 2018 or so on. So it is our outlook, and this is, I'm wrapping up and we'll have time for Q&A. So I'm going to break this down by spot and contract because they are very different in terms of how quickly they move. They're not so much different directionally. Contract rates tend to lag spot rates by 6 to 8 months. That might be a little bit shorter now for reasons of technology and business strategy, as shippers often want to do quicker bids to take advantage of declining rates. Some of you may be doing that as well, where you might have had an annual RFP. Maybe now you're doing quarterly. That has the effect of shortening that cycle a little bit. As we look at spot rates, they are starting to turn, as we talked about earlier, they're starting to turn positive year over year. But that's a very shallow sort of, upturn. We're looking at spot rates being up next year about 8%. Now, that sounds like maybe a lot, but in a normal, I shouldn't say normal upturn, like in something like we had in 2021, they went up 25, 30% in 1 year. We had something very similar in 2017, 2018. So an 8% increase in spot rates, while that might sound like a lot, really is not in the scheme of things. Now, contract rates really have not clearly bottomed out. We believe they have, but we're really not starting to see contract rates start to go positive year over year until probably late this year, maybe even early next year. And then starting to see a little bit of acceleration by Q2 of next year. But again, not tremendously strong. Next year, we expect contract rates in dry van to be up about 2.5% compared to where they were this year. This year, they were down. So not a strong, nothing really to fear. That's sort of my big message here is, I think a lot of people have become accustomed in the last few cycles of, oh my gosh, rates have come way down, that means they're about to go way up. Don't think that's what's going to happen. I want to talk a little bit about LTL. Haven't really talked about LTL versus truckload during the presentation, just as a matter of focus and time. LTL has a different dynamic, and it's all because of one reason. I'm guessing probably many of you used Yellow Freight for some of your transportation. If you've used them since August of last year, you must be living in a different universe because they don't exist anymore, and they shut down at the end of July of last year. That has firmed up LTL in terms of pricing. Hasn't really done much more than that, though. LTL is still a pretty weak sector from a volume standpoint, so they're not getting the kind of rate inflation you might expect. So this is a pretty soft recovery for LTL when you consider that 10% of its capacity left the market in one day. In a stronger market, had that happened, we probably wouldn't have lost Yellow, but in a stronger market, we would have seen double-digit increases probably in rates. So LTL is obviously firmer than truckload, but I would say it's still pretty comfortable, especially if you have a need to take advantage of that versus truckload. And then finally, let's look at flatbed and flatbed spot and contract rates. Very similar to dry van directionally. We are running positive, but much smaller positives year over year in dry van or in flatbed. But we are looking to see a little bit more inflation there because we do expect to see a little bit more capacity constraint there. I didn't really get into, I showed you, but I didn't really go into any detail, the difference between truckload employment and flatbed employment. I mentioned it, but I didn't highlight it. And while we're up 4% in truckload employment versus February 2020, we're down almost 4% in specialized, which is primarily flatbed. So one of the issues flatbed does have is that it has a much greater, relatively speaking, capacity constraint than does dry van. Then finally, this is pretty similar to what we see with dry van, which is we have not, according to our forecast, we actually haven't bottomed out yet in contract rates in flatbed. And again, still not looking to see upward gains actually until really the middle of next year. So that's a little bit different. Dry van, we expect to see that inflection. I should have pointed out the first slide that I showed that the green line is an index level representing what the actual rate is. So when you download this and go back and look at it, you can interpret this chart better than the way I, since I didn't describe it in detail. But the bars are year-over-year changes. The green line is an index level showing kind of where things are. Now, flatbed is even stronger versus the peak of the prior market. But one thing I have not gotten into in this presentation is the cost side, because that would be its own presentation. Pay for drivers has gone up. Equipment costs, especially trailers, have dramatically increased because of the supply chain costs and effects. So the margins are really not any better. In fact, a report that came out just a few months ago shows margins last year are considerably tighter than they were even the year before. So 4 key takeaways here. I'm not going to read them all because I've already covered them, but basically it is a much softer market than what you saw 3 years ago. It is likely to still be a much softer market than when you saw 3 years ago for the future, pretty much as far as we can see ahead. We just do not see that kind of dynamic. Now, we had a black swan event that caused all of that. So we don't forecast black swan events. If we did, number one, I think the FBI would be coming to our door, like, how can you forecast a black swan event? And are you causing them? But, these are things that are unknowable. So, again, absent an event like a pandemic, this is how we're seeing the market. So with that, I think we have maybe 5 minutes or so to handle questions.
You bet. One of the things, hi, my name's Dirk from Lakeside Book. One of the things I didn't hear you mention at all was autonomous vehicles and the future for them.
Sure.
You have a couple minutes to expound.
Sure. So eventually they are coming. I think there's a couple of issues in the near term. The biggest issue probably is the fact that it's going to freak people out to be driving down the road and seeing a truck with no person in it. Now, the short-term solution that's been offered by the government is, well, we'll have someone in there to monitor the system and all that. Well, the problem with that is economics. If you have to hire a person to be in the truck anyway, then that pretty much destroys the whole business model of doing autonomous. So it doesn't work. You could possibly have it work where there's a driver resting, and then that person may drive later, but a person sitting in the seat, not going to work. So that's issue one. Issue two, frankly, is the fact that we don't have a driver shortage right now. So we had two things happen at the same time that were kind of related, I guess, in a way. We had basically the free venture capital that was in the broader U.S. financial market dry up because of the Fed interest rates to attack inflation, which we didn't get into today. But and so a lot of companies that were speculating on autonomous all of a sudden like, oh, we can't really do this unless we can show a near-term payback. And of course, there was no near-term payback to show. So that was issue one. And then issue two is the fact that we don't need autonomous because we can get as many drivers. Now, as we look ahead, the model that I think probably will work is something that looks a lot like intermodal. You can just think of it as intermodal using the interstate, which is that we will have transfer hubs probably at various locations along major corridors. I-10, I think, probably will be the first one. I-90, possibly the second one. But you will have autonomous trucks running hundreds of miles between them with local drayage. So you'll still have sort of a drayage model. When will that happen? I think we may see substantial use of that by the end of the decade in limited places like I-10. But I don't think we're looking at seeing that model really taking hold for another decade or more. But we are probably heading that way. But it's going to take a long time, and it's going to be a long time before it is the dominant model. In fact, we're talking probably the 2040s or 50s before it's the dominant model.
So not a black swan event, but maybe the elephant in the room for us
I think I know where this is going.
might be the infrastructure situation.
Not what I thought you were going to ask about.
And the deterioration of that. And so I'm just curious because our company uses both truck and rail. And where do you see that being disruptive and the timeline for that? And how long before this becomes a big issue?
Well, so the infrastructure issue is kind of perennial for trucking, right? I mean, we have the bottlenecks at major locations throughout the country. Atlanta's a huge one. Dallas is a huge one. There's a whole bunch of them. And of course, we do have infrastructure, quality issues. The problem with rail, though, is really more of a capacity issue. I mean, for obvious reasons, you can only get so much, capacity on a given rail line at a given time. That gives us, I think, a look at, trucking being more resilient, right? You can work around construction issues and bottleneck issues in a way that you really can't in rail. And so as we look ahead, it's just going to be one of those, death by a thousand cuts issues. It's going to get harder and harder, but it's going to be so gradual, I think, in trucking that it's going to be hard to say where exactly, we went off the rails, so to speak. So I don't know if that really addresses your question, but it's, of all the things that the industries care about, I mean, they talk a good game on infrastructure, but really there's a whole bunch of other issues that when, rubber meets the road or doesn't meet the road, I guess, that they care more about. Yeah.
Time for one last question, if anybody. Okay, Joe, hold on.
What was the question you were anticipating?
Oh, I thought it was going to be asked about tariffs. Should I answer the question?
Yeah, go ahead.
Okay. So obviously the big question is, depending on the outcome of the election, if the big issue, of course, is what is being promised going to actually be delivered? time shows that no matter what side you're talking about, you don't get exactly what is being promised. So our assessment is that a blanket tariff is not likely to happen for a whole host of reasons. The biggest one of which is, number one, that's going to skewer a lot of oxes out there, but it's also going to be essentially a tax increase on consumers. So it's not likely to have. That's not likely to happen. So if it does, it's going to be pretty devastating in the near term. The real debate becomes what is the longer term effect of that in terms of things like infrastructure and things like manufacturing. How much more of that happens here. So I don't. I probably should have kept my mouth shut because I don't really have an answer to the question I thought I was being asked. But I will say that I think that over the next, say, 2 to 3 years, a broad tariff would have a much bigger negative impact than it would have a positive impact. If we get through that, maybe it'd be more. But the problem is, I think most of you have manufacturing facilities. Some of you, I'm sure, have partners in other countries. Having to, move those, either, have to pay the tariffs or move those quickly is going to be very disruptive. So it's going to be a difficult haul if that happens. Anyway, sorry, I gave a non-answer to that question. Anyway. All right, thank you.